Hello, my name is David, and I will be presenting on the paper Disclosure Level and the Cost of Equity Capital. This paper was written by Christine A. Botosan and was published in the Accounting Review in 1997. All right, first, what are we looking at? Our research question has to do with the relationship between disclosure levels of a firm and their level of cost of equity capital. Do firms that disclose more information have a lower cost of equity capital than similar firms who did not choose to disclose as much? And then if this relationship exists or if it doesn't, does cost of equity capital get reduced by more dependent upon the level of analysts following the firm? Would more analysts result in a lower relationship or no relationship at all? These are kind of the two questions we are looking at. And the reason that this is important is because there has been a conflict between the AICPA and Financial Executives Institute. A conflict might be too strong, but they disagree on their belief of the effect of extra disclosures. The AICPA believes that greater disclosures will lead to lower costs of capital, whereas the Financial Executives Institute believes enhanced disclosures would add to share price volatility, increasing cost of capital. In general, academia tends to believe in the negative association that the AICPA believes in, that enhanced disclosures will lead to lower cost of equity capital. There's just some disagreement in academia about why it does it. There are two competing streams of literature that we will discuss in a little bit. This paper tries to resolve that conflict, and does so by confirming this negative relationship exists for firms with low analyst followings. So for firms that don't have as many analysts tracking their behavior, these tend to be smaller firms, so firm size and market risk was controlled for in this study. But those with smaller analyst followings tend to get greater benefit in reduced cost of equity capital by increasing their disclosures. So the way we test it, this cost of equity valuation is we took a model from Edwards and Bell 1961, Olson and Feltham Olson 1995, it was commonly referred to as the EBO valuation formula, and adjusted it a little bit in order to be able to account for this disclosure levels. There are several potential ways of estimating cost of equity capital, but this was the only one that allowed us to put in our measure of distribution level or disclosure level. And what we expect to find using this model is this negative association. Now, as I said before, the academics are kind of in two streams about why it would be lower. First, you have Amihud and Mendelsohn and several other papers that believe greater disclosure enhances stock market liquidity, thereby reducing cost of equity capital through either reduced transaction costs or increased demand. Now, they are disagreed with by Klein and Bawa, as well as several other papers on the other side of the stream that believe greater disclosure reduces estimation risk arising from investors' estimates of the parameters of an asset's return or payoff distribution. Now, what they mean when they say that is that when your information level is low, there's greater uncertainty risk. And so as you increase your level of information provided to investors, decrease this potential level of information asymmetry, the risk goes down and the investors are willing to generally pay a little less for the stock or for the equity if they can better estimate its value. So by increasing the information, you're decreasing the risk. All right, the two hypotheses from this paper. First is just a general that a negative association exists between disclosure level and cost of equity capital. Now, what we find when we go a little bit into this is that while no significant relationship appears to exist between disclosure level and cost of equity capital for all firms. However, when we break it up and look at hypothesis 2, and we separate the large analyst followings from the small analyst followings, we find that there is a significant correlation between the two. Now, how we did it was we drew our sample from the machinery industry from 1990. Now, the reason we did the machinery industry was that it has high variability of both analyst following and disclosure level. The industry does not have stringent requirements as other industries on what must be disclosed, which allows firms to vary. Because we have this variability and the industry is sufficiently large enough, we're able to draw a final sample of 122 firms. We lost some due to them not responding to us when we asked for information, there not being enough data in the CRISP database to calculate a cost of equity capital score, and so after everything we result with 122. So first thing we need to do is come up with a measure of distribution value, or D-score. And as you can see below, the D-score is the summation of points given based upon 5 categories. And these categories begin with background information, which involves statement of corporate goals or objectives, barriers to entry are discussed, competitive environment, general description of the business. Just general background information freely given by the firm in their annual report. All of these are taken from the annual report. The reason we're able to use the annual report is because firms, and able to use 1 year, is because firms' disclosure levels are not expected to change very much over time. They're generally pretty static. And so we take these 5 categories, and if they are disclosed on the annual report, they get a point or they don't get a point, and then all those points are added up to get the final score. The next category is the 10 or 5-year summary. So do they disclose summary statistics from either the last 5, 10 plus years? And these include return on assets, or enough information to compute return on assets, and net profit margin, or sufficient information to compute net profit margin. Next category would be key non-financial statistics. These include number of employees, average compensation, order backlog, among others. And the next category is projected information, or forecasted market share, cash flow forecast, other forecasts into the future. And the final category is management discussion and analysis. And these kind of relate to changes in sales, change in reporting income, change in cost of goods sold. So all these points are totaled up for each category and then totaled up to come up with our score. And then our second hypothesis is if low analyst firms have a higher relationship between, or a more negative relationship between disclosure level and cost of equity capital than higher analyst following firms. So we do a median split at 9, where 62 firms have 9 analysts or less, and 60 have 10 or more. All right, looking at hypothesis 1, you can see we regress our cost of equity capital on these variables. The one most interest to us is the disclosure ranking. As you can see by the coefficient, it goes in the correct direction, but unfortunately it is not a significant relationship when using all firms. So when controlling for our market risk, our market beta, and our market value, the D rank becomes insignificant. When regressing cost of capital equity just on disclosure ranking, we find a significant result, but once controlling for variables that should make a difference, our result goes away. So moving on to our second hypothesis, we can want to look here at our disclosure ranking, or D rank, interacting with DU, which is the separation dependent upon number of analysts following. And we find again it's moving in the correct direction. It is another negative relationship, and it's significant, as you can see by our p-value. So in the end, we find results that are consistent with our hypothesis for hypothesis 2, but for hypothesis 1 we do not have the evidence to say that a relationship exists. So relationships do appear to exist for firms where new information is being given, or the slower analysts following firms. Because there are fewer analysts following, the expectation is that these disclosures are offering more unique information than firms that are being followed by more analysts. So then that becomes, where can we go from here? Well, the first thing we can do is take this adjusted EBO valuation model, which we adjusted to make it better for disclosure rankings, and continue our tests into the future with other industries, maybe using scores that we chose not to include in this one because that would have hurt our cross-sectional variation, such as the AIMR, or Association for Investment Management Research. This association releases disclosure rankings for large firms. We could get a large sample size and test it. Unfortunately, there'd be very little variation in size due to who makes it onto the list. But with the new measure, opportunities do exist going forward. And I want to thank you all for your time and hope you have a nice day.